Good evening. I'm Mamta Rawat from the corporate communications team of CareEdge, and it's my pleasure to host today's webinar on renewed momentum, thermal power's new dawn. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel of designate at GMR Energy, Mr. Ajay Bagri, CFO at SAIL Energy India Limited, Mr. G. Samba Siva Rao, Vice President Power at AC Vice President, Lending and Project Finance at National Bank for Financing Infrastructure and Development. This session will be moderated by Sabyasachi Majumdar, Senior Director at CareEdge Ratings. We will begin this webinar with a presentation by Shailendra Singh Baghel, Associate Director at CareEdge Ratings. Following the presentation, we will move into a panel discussion, followed by an audience Q&A. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Shailendra to make the presentation.
Thank you, Mamta. Good afternoon, everyone. The topic for today's webinar is Renewed Momentum, Thermal Power's New Dawn. India's thermal power sector has witnessed a renewed interest from developers after years of subdued investment. The state distribution utilities initiated long-term power procurement tenders, boosting revenue prospects. Fuel supply risks have moderated thanks to better ACQ realizations under FSA with Coal India and narrowing premium of e-auction coal over FSA prices. Merchant sale realization continues to remain high than historical trends, supporting the profitability of thermal assets without long-term PPAs. In parallel, payment discipline from state utilities improved after the late payment surcharge rules, strengthening IPP's liquidity profile. The Central Electricity Authority projects capacity addition of 80 gigawatt to meet rising power demand by FY30. In today's webinar, we would like to cover the key changes in thermal power sector in the recent past and the way forward. The content flow in today's webinar includes the following: sector overview and trends, recent developments, DISCOM performance, key drivers and challenges, followed by outlook for capacity addition. To set the context, we'll take an overview of the sector and key trends. Moving on to demand growth, as indicated in Exhibit 1, energy demand grew at an average rate of 7.4% during FY22 to FY25, significantly higher than the 4% growth recorded in the later half of the previous decade. This trend aligns with average GDP growth of 7.8% over the same period. Although demand growth moderated in 9 months FY26 due to above normal rainfall, the long-term outlook remains healthy and is expected to track robust GDP growth projections. Exhibit 2 shows that peak demand touched a record high of 250 gigawatt in May 24. While elevated rainfall led to subdued demand in Q1 FY26, winter peak demand reached a new high of 241 gigawatt in December 25. Meanwhile, the peak deficit improved to zero in FY25 compared to 1.2% in FY24. Next, we talk about thermal share in generation. Over the past 6 years, the country's installed generation capacity has expanded by 119 gigawatt. However, thermal capacity additions have remained relatively modest at 33 gigawatt. The central and state sectors have contributed the bulk of these additions. Recent capacity growth in the power sector has been predominantly driven by renewable energy, supported by lower execution risk and strong policy impetus. Despite this shift in capacity composition, thermal power continues to account for a substantial 75% of total electricity generation. This is attributable to the baseload characteristics of thermal plants, adequate availability of domestic coal, and the inherently lower plant load factors of renewable sources. Notably, solar and wind together contribute about 14% of total generation in FY25, despite representing nearly one-third of the installed capacity. The share of hydro and nuclear generation has remained limited, largely due to the slow pace of capacity addition stemming from their long gestation period. In the next section, we have highlighted the annual trajectory of capacity addition within the thermal generation segment. Average annual thermal capacity addition declined significantly from 17 gigawatt during FY13 to FY18 to about 5 gigawatt in the last 6 years. This reduction largely reflects the increasing policy emphasis on renewable energy coupled with various challenges faced by thermal sector in the past. Operational performance has, however, improved. The plant load factor of thermal power stations across central, state, and private sector ownership has strengthened in recent years. The 56% in FY20 to 69% in FY24 and FY25. While cost plus regulated projects experience limited gains from higher generation, private sector plants with untied capacity have benefited in terms of higher profitability. Next slide focuses on fuel risk. As illustrated in Exhibit 6, domestic coal dispatch to the power sector recorded a CAGR of 11% during FY22 to 25, significantly higher than 4.4% seen in FY15 to FY20. This increase was driven by enhanced production from Coal India Limited and its subsidiaries. The sharp reduction in e-auction premium over CL's notified prices has further helped lower fuel cost for merchant IPPs. Imported coal prices have remained relatively stable in 45 to 60 USD per metric ton range over the past 2 years compared with a much higher average of around 200 USD per metric ton in the preceding period, reflecting weaker global demand. At these levels, the landed cost of imported coal in coastal states is broadly comparable to domestic coal, thereby improving merit order position of these plants. This has contributed to a moderation in the average power procurement cost for state distribution utilities. Next, we focus on short-term power procurement trends. The share of short-term power procurement has increased to 12 to 13% over the past 4 years compared with the historical average of 10 to 11%. This rise has been driven by a robust demand growth and limited long-term PPAs by state distribution utilities. Concurrently, average realization from short-term sales have remained above 4.5 per unit, a marked increase from the earlier range of 2.5 to 3 per unit. The combination of elevated merchant tariffs and availability of e-auction coal at affordable prices has strengthened the financial position of merchant-based power projects. However, short-term tariffs have moderated in year-to-date FY26, and the sustainability of merchant prices remains to be seen. It is further observed that merchant realization increasingly varying by time of day, reflecting the growing penetration of intermittent renewable energy. Consequently, thermal generators are required to operate more flexibly with frequent ramp-up and ramp-down cycles in order to maintain grid stability. Having taken an overview of thermal generation, we'll now dive into the recent developments in the sector. Next, we discuss the recent thermal bids by DISCOMs. As indicated in Exhibit 10, state distribution utilities have awarded approximately 15 gigawatt of new thermal PPAs over the last 2 years, driven by the need to secure long-term baseload capacity. Industry sources also suggest that an additional 17 gigawatt of thermal capacity is currently at various stages of bidding. The absence of long-term PPAs has historically been a key structural challenge for the thermal segment, and these recent tenders mitigate the demand risk to some extent. Furthermore, the capacity charges discovered in recent bids range from 3.4 to 4.4 per unit, reflect the higher capital cost for these projects in the range of 12 to 15 crore per megawatt. This slide highlights key reforms in the coal segment. As depicted in Exhibit 11, the Government of India has abolished the coal compensation cess of 400 rupees per metric ton and simultaneously increased the GST rate on coal from 5 to 18%. This change is expected to reduce the landed cost of coal by approximately 150 to 200 per metric ton and result in annual savings of 12 to 14,000 crore for state distribution utilities. Exhibit 12 highlights that the recent changes in Shakti policy in May 2025. The updated framework provides two distinct allocation routes: allocation at the notified price for central and state-owned generating companies and allocation through auction mechanism for private developers at a premium over notified price. The Shakti policy has improved coal access for independent power producers without long-term PPAs, and updated framework is expected to enhance coal availability for imported coal plants. This slide talks about recent FGD implementation behavior. As per the MOEF notification issued in July 2025, Category C thermal power plants have been exempted from installing FGD systems, while implementation for Category B plants will be considered on a case-to-case basis. This development is favorable for the sector as it reduces capital expenditure requirements and mitigates the uncertainty around tariff recovery for such investment, particularly for competitively bid projects. As noted earlier, the tariffs discovered in recent long-term bids for thermal capacity fall in the range of 5.5 to 6 per unit, which is higher than the tariff for standalone solar and wind projects. In addition, the tariff in recently concluded RTC and FDRE tenders are in the range of 4 to 5 per unit. Although these tariffs are broadly compared to those discovered in thermal bids, it is important to recognize that thermal generation continues to play a critical role in meeting baseload demand. Having taken an overview of thermal generation, we'll now dive into power distribution sector, which has a direct impact on the credit profile of thermal gencos. As shown in Exhibit 15, the book losses of distribution utilities remained elevated at 27,000 crores in FY24, although substantially lower than 57,000 crore reported in FY23. The reduction was primarily driven by decline in AT&C losses, modest tariff revisions, and stable power procurement cost. While the discoms collectively reported a net profit of close to 3,000 crores in FY25, several of the large state-owned utilities continue to incur book losses. Exhibit 16 indicates that the gross debt of discoms increased by approximately 50% between FY19 and FY24, reflecting debt-financed capital expenditure, higher working capital requirements, and borrowing from PFC-REC for settlement of Genco dues. Although gross debt declined marginally in FY25, it remains elevated at 7.3 lakh crore. The top 5 states together account for 60% of the sector's total debt. The cash gap per unit, measured as the difference between average cost of supply and the average revenue realized, has narrowed significantly from 46 paisa in FY23 to 7 paisa in FY25. During this period, the ARR improved by approximately 40 paisa, while the ACS remained broadly stable, supported by a 10 paisa reduction in power procurement cost. In absolute terms, the cash gap has declined from 58,000 crore in FY24 to roughly 13,000 crore in FY25 as per our estimates. AT&C losses have also declined to 15 to 16% over the past 4 years compared to 21-22% in the earlier years. This improvement is attributable to enhanced billing and collection efficiency. Billing efficiency improvement is led by replacement of defective meters, anti-theft measures, and segregation of agriculture feeders. Additionally, timely subsidy disbursement by state governments and improved realization of dues from government departments has contributed to higher collection efficiency. Exhibit 19 highlights the decline in outstanding dues owned by distribution utilities by 54% since September 21 to 526 billion rupees as of July 2026. The proportion of overdue receivables has reduced to 30%, supported by liquidity infusion from PFC-REC and implementation of LPSC scheme. This has supported liquidity profile of IPPs. The Government of India has initiated several reforms aimed at improving the financial sustainability of state distribution utilities. The RDSS scheme, with an overall outlay of 3 lakh crore, targets a reduction in AT&C losses to 12 to 15% and elimination of ACS ARR gap. Of the budgetary allocation of 970 billion rupees, approximately 370 billion has been disbursed to date. A key component of the scheme is the rollout of smart meters, with 5.4 crore installation completed under the TOTEX model, representing around 25% of the implementation target. In January 2026, the government also released the Draft National Electricity Plan, which proposes measures such as automatic tariff adjustment, timely issuance of tariff order, and a phased reduction in cross-subsidy levels. Additionally, media reports indicate a 1 lakh crore bailout package for discoms is under consideration, including potential proposal for discom privatization. Collectively, these initiatives are expected to strengthen the financial position of the distribution segment. Having taken an overview of the power distribution segment, we will touch upon the key drivers and challenges of power generation sector. The issuance of long-term thermal tenders by state distribution utilities over the past 2 years has enhanced revenue visibility for under construction projects and is expected to support medium-term capacity addition. These developments reinforce the continued importance of thermal power in meeting base load requirements given the intermittent inherent in renewable energy generation. The financial position of major private sector thermal generators has also strengthened in recent years, which improves the visibility of equity commitment for upcoming investment plans discussed earlier in the presentation. Furthermore, improvement in the payment discipline of discoms in recent years has been a positive for the thermal segment. Herein, we touch upon key challenges faced by sector. Thermal power projects entail a long construction period of 4 to 5 years, exposing them to cost or time overrun. Land acquisition hurdles, high capital cost per megawatt, and a limited pool of BTG suppliers are the key execution risks for such projects. The rising penetration of renewable energy combined with a must-run status necessitates higher operational flexibility from thermal power projects for which an appropriate compensation framework is awaited. As highlighted earlier in the presentation, merchant tariffs have softened in year-to-date FY26, which may impact thermal plants with untied capacity. The sector remains exposed to regulatory risk as any change in law event requires approval from the relevant state electricity regulatory commission or central electricity regulatory commission. Historically, the regulatory orders were issued with a delay, impacting the financial profile of IPPs. Although payments on distribution utilities have been timely in recent years, their overall indebtedness remains high, and sustained improvement in discom financials remains critical for the health of the sector. Now, we would like to conclude by sharing our outlook on capacity addition in the thermal segment. The key structural drivers of future electricity demand include an increasing share of manufacturing in GDP, sustained economic growth, rising adoption of electric vehicles, and continued urbanization. The Government of India's policy initiatives such as Make in India and PLI scheme aim to raise manufacturing sector's contribution to GDP in the medium term. Moreover, electricity demand has exhibited a strong positive correlation with GDP growth. Hence, higher share of manufacturing and higher GDP growth are expected to drive incremental energy consumption. In addition, rising urbanization and growth in per capita electricity consumption are likely to further underpin long-term demand growth. Over time, the increased penetration of EV is expected to shift a portion of fuel demand from petroleum products to electricity. Assuming an annual energy demand growth of 6% per annum, consistent with medium-term GDP projections, the country's installed generation capacity is expected to increase to about 760 gigawatt by FY30. Within this, renewable energy capacity is projected to reach 460 to 500 gigawatt, reflecting continued policy support and accelerated deployment. Non-renewable capacity, including thermal generation, is anticipated to rise by roughly 45 gigawatt, taking the total to 300 gigawatt. Given the must-run priority according to renewable energy, the share of thermal generation in overall electricity generation is expected to moderate to 55 to 60%. Nonetheless, thermal power will remain essential for meeting baseload demand and ensuring grid stability. With this, we would like to conclude the presentation. Thank you. I'll now like to hand it back to Mamta.
Thank you, Shailendra, for that comprehensive overview. A quick reminder to all attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Sabyasachi Majumdar, to take the discussion forward. Sabyasachi Majumdar is a senior director at CareEdge. He has over 25 years of experience in credit rating and sectoral research across diverse sectors such as power, renewable energy, cement, sugar, chemicals, oil and gas, etc. He is an alumnus of IIM Lucknow and Delhi College of Engineering. Over to you, Sabyasachi.
Yeah, thank you, Mamta, and good afternoon, everyone. An excellent presentation by Shailendra, which sets the context very beautifully for our thermal power webinar today. It's my pleasure to introduce our distinguished panelists who bring extensive experience and valuable insights from across the power and infrastructure sectors. We look forward to an engaging and informative discussion today. Our first panelist is Mr. Suresh Nagarajan. He is an accomplished power sector leader and a chartered accountant, also qualified as a company secretary. With over 3 decades of experience across India's power and infrastructure landscape, he has played a key role in developing and operating large-scale thermal and renewable energy projects, including IPPs and integrated power assets. He previously served as CEO of DB Power, where he successfully led a business turnaround through operational excellence. During his long tenure at Reliance Power, he was instrumental in developing India's first UMPP from concept to commissioning. He has also worked with companies such as Tata Power, SBI Capital Markets, and PSEG India, and currently is serving as CEO designate at GMR Energy. And he brings strong expertise in project development, asset optimization, strategic growth, and uh, organization leadership. Very good afternoon, Mr. Nagarajan. Welcome to our webinar.
Thank you, Sabisaj.
Joining him in the panel, we have Mr. Ajay Bagri. He's a senior finance professional with 25 years plus experience in the power sector, currently serving as CFO at SEIL Energy India Limited, managing a portfolio of 2,640 megawatt of thermal generation capacity. He had a long stint with Tata Power and possesses strong expertise in the M&A, financial structuring, fundraising, and regulatory affairs and strategic transformation. He's a regular speaker at industry forums and an active contributor to policy and sectoral discussions. Very good afternoon, Mr. Bagri. Welcome to our webinar.
Thanks, Sabyasachi, and good afternoon to my fellow panelists and audience.
Yeah, okay. Next, we have Mr. G. Samaseva Rao. He's a seasoned power plant professional with nearly 3 decades of rich experience in thermal power generation and large-scale asset management. He currently serves as divisional head power at the ACBIL Group, where he provides strategic and operational leadership across 6 power plants, driving reliability, efficiency, and cost competitiveness. He spent over 23 years with the Vedanta Group in senior leadership roles, contributing significantly to the development, stabilization, and turnaround of some of India's largest thermal power projects. His expertise spans subcritical as well as supercritical power plants across both captive as well as IPP business models. Mr. Vibhudatta Das. He is experienced large corporates. He currently serves as Vice President Lending and Project Finance at NAPFED, working in the energy vertical with a focus on project appraisal, deal structuring, and portfolio management. He has previously held key roles at the Kotak Mahindra Bank, ICICI Bank, and started a Standard Chartered Group. CA by qualification, he brings strong expertise in energy finance, risk assessment, and stakeholder management. And thank you again, gentlemen, for joining us today. And
Thank you,
let us
Sabyasachi.
begin with our first question. Let me address it to Mr. Nagarajan. How do you, what do you, I mean, we have a certain expectation of, power sector growth in the medium term. So what is your expectation about power demand growth in the near to medium term? And particularly with the significant capacity addition in renewables, do you expect it to have an impact on the growth in the thermal segment in the medium term?
Sure. See, the power sector post-COVID has been growing at about 5 to 6%, thanks to the growth in the demand with the various sectors. Some of them were highlighted in your presentation. And for the next couple of years, say medium term to long term, say 5 to 10, 15 years time frame, we expect the growth based on various reports and the demand analysis. We expect the growth to be maintained at the same levels of about 5 to 6%. So considering this demand projection, the policymakers and the Ministry of Power have charted out a plan in terms of across various fuels and source of generation, what kind of capacity addition is required by 2030 and 2035. And by 2035, the overall capacity addition envisaged through renewables alone is much larger. So of the order of about 400 to 500 gigawatts. At the same time, since renewable is a variable nature of power and intermittent in nature, thermal is expected to play down the line as a balancing load. Today, it is predominantly playing it as a base load and still contributes about 75% of total energy consumption in the country. With more and more renewable penetration, thermal is expected to go down in terms of overall energy mix. At the same time, it is expected to play a lead role as a balancing power to the grid, primarily given the fact that renewables are intermittent in nature. So considering that the thermal coal capacities addition expected by 2035, again estimated by our policymakers, the CA and MOP, is about 307 gigawatt. So as against this, today we are sitting on about 225 gigawatts. So that leaves about the gap of about 97,000. Out of this, the various capacities to the tune of about 35 gigawatt are under construction. And about 15,000 megawatts are already awarded in the last 1 year. That was also captured in your presentation. So considering all these things, that leaves a scope for adding another about 30 to 32 gigawatts of thermal capacities to meet this demand. So coming back to your question in terms of energy growth and in terms of what is the growth expected for thermal. For thermal till 2035, there I could see that still there is a scope for adding further capacities to the tune of about 30 gigawatt. So taking into account the capacities already operating, under construction, and already awarded capacities.
Okay. Mr. Rao, the same question to you. How do you expect the demand to pan out in the near to medium term?
I think near to medium term, definitely this is going to sustain the 6%. Even the financial year, April to December, if you see last year to this year comparison, so close to 1308 billion units generation, and then means the demand, and 1386 has come now. That is close to 6%. And I reaffirm that the demand will continue to be there the same range. And as Mr. Suresh explained clearly on the renewable front, 500 gigawatt is the already the target set by the government by 2030. So accordingly, the thermal capacity, the percentage wise it is going to go down, but absolutely in terms of absolute it is going to go up. And looking into the last 5 years scenario also, integration is the major key here. And any small gap in that is going to create once again the demand for the thermal, which will be add on further whatever is expected. So this may go even beyond this 35 to 40,000 megawatt what it is expected. So looking into the scenario of integrating speed of the renewables.
Okay. Mr. Dash, as the financier, do you still see, I mean, in the financing system, thermal power projects coming up for lending? I mean, is the sector, I mean, infrastructure funding sector still seeing demand from the thermal power? I mean, apart from CPSUs, are you seeing demand for funding from the private sector developers?
Yeah, so I'll break it into two parts. Recently most of this large financing which we have done, from my organization or from the banking sector towards the thermal project, these are most towards the acquisition of the stress asset, which has happened, and the portfolio was standard for a long time, about 40 gigawatt, and were recently acquired by strong player like Adani, JSW, Jindal. So that has completed, the IBC process has done, and that has been moved. And those have a quite significant, demand by the banker or the lending side, where they are comfortable because of the portfolio and the new large developers, where they have completed the project and stabilized the operation. So with respect to the greenfield, I think there is little shift where we are seeing the greenfield will be more, the lenders will be shifted, the approach has mostly shifted to a selective risk and mitigated lending way, where exposure today is more quality driven, not a volume wise they want to run. And ESG consideration have impact some of the global banks. But domestic lender, though, still okay with this ESG frameworks. So some of these key risks which lenders still see are there. However, some of the majority has mitigated, like the way the ways improve contractual structure, your payment security mechanism, which combined with the LPS enforcement, and there is your long-term PPA, which has the flexibility of fixed capacity charge and indexed charges. We have also this fuel X, which now getting mitigated, which is with the Shakti scheme. Your captive, captive coal block and improved domestic availability of the coal has gone up. There is a better, project with respect to PLF and low emission norms. So this is giving some comfort to the greenfield. However, I believe that the banking, the lending to the power is evolving, and the appetite still exists to the project which is efficient, contracted, and aligned to the Indian transition need. So it will have appetite is still there with the lenders to both thermal as well as the green.
Thanks. Mr. Bagri, my question to you, pertains to the, merchant power price. What we have seen is that in the current financial year, by and large, merchant power tariffs have been softer, mainly, because of the reasons that, Shailendra alluded to, because of, prolonged monsoon as well as, less intense summer. But do you see how do you see the medium term trends in terms of the merchant tariff? Do you feel that the soft trends will continue, or do you see that it will again pick up in the medium term? And overall, how do you see the prospects for power projects which are predominantly merchant?
Uh, so actually, I would like to add something on the first question because it's a bit related to this question as well. With respect to the prospects of the thermal in view of the renewable and the overall expectation of the growth rate for the energy, I would like to add a couple of points that this percentage is what we have been seeing for the last 2 years was considering a very stable kind of a situation. But owing to the recent geopolitical issues which has cropped up, whereby the oil is driving economies, what I see is energy security is going to take a front seat in the minds of the regulators, and therefore a faster adoption to EV, a lot more stress on the manufacturing, making the country independent and focusing more on exports. This would lead to faster or maybe I'm little more bullish on the demand growth for the electricity because the reliable power is going to be one of the key ingredients to achieve those objectives in order to counter these issues. Therefore, I'm little more bullish on the demand, and as the things unfold, the recent trade deal which has happened after a period of 20 years would open much more avenues for manufacturing to be strengthened in India. Therefore, the demand for electricity would definitely lead to both renewables and thermal picking up. But as the world stands today, somehow the capital commitment, so the commitment towards reduction in the carbon credits and all, they are still there, but thermal has now taken a front stage. And what we have seen over the last 2 years that both in terms of the regulators or the from the funding side, there is not they are not averse to the thermal sector. We have very recently done a very large fundraise, which was well supported by the funding agencies. In terms of the merchant prices, while I am quite bullish on the thermal, but in terms of the merchant prices, I see that the kind of levels which we have seen in the 24, 25, and now bit subdued in the 26. But those higher levels may not, we may not see it again. There seems to be two, three reasons for that. At that point of a time, because these policies shift, the demand supply gap, there was a mismatch, and therefore which led to a increased IEX prices. But now the capacity addition is happening, and there is a lot more focus. Although you have very well highlighted the key challenges in those achieving those targets of the capacity additions. But in case if we are able to tie up, then there would be a sufficient capacity addition to cope up the supply demand for the electricity, and I don't see much of a demand supply gap in the coming years. So therefore, I feel that the IEX prices, the merchant prices would be at these levels, although they can definitely be in line with the new tariff discoveries, which we'll see by way of the higher capacity charges of the thermal, as you have highlighted in the presentation. Secondly, in terms of the merchant market, mostly it's thermal capacities. Whenever they are coming, they are tied up with the long-term power, so they are not going to be the major players into it. While the renewables will be driving those prices. So I don't see a bit of a very higher levels as we have seen in the past, and prices to stay around these levels in the near future.
Thanks, Mr. Bagri. That was very, informative. My next question is to Mr. Nagarajan, regarding the tariff competitiveness of the thermal industry as a whole. Now, what we are seeing lately is that the new, long-term thermal bids which are coming out, they are coming out at, 5 rupee 50 paisa to 6 rupee. Some of the completely new greenfield projects, in fact, have even been bid out at 6 rupees. But at the same time, we do see, a lot of, FDRE, RTC kind of projects, which are, being bid out at, let's say, between 4 to 5 rupee. Now, does this mean that in the long run, we don't see thermal being competitiveness with being competitive with RE, even if all the implicit and explicit subsidies are removed? How do you see, I mean, the long term competitiveness play between these two complementary power sources to play out?
Basically, the recent bids, what you listed, to the tune of about 15 gigawatts, the last 1.5 years, the bids invited by the various discoms, they have all resulted in the tariffs, what you indicated, say, of the order of about 525 to 575, 6 rupees types. So they are all based on supercritical technology, where the moment you mentioned supercritical technology, it is either 660 megawatt or 800 megawatt, where the capex is on the higher side. So we are today talking about capex of the order of 13, 14 crores per megawatt for setting up the new greenfield power plant based on supercritical technology. So that is the major contributor for the cost increase. So one of the policy advocacy that has been doing the rounds is that any thermal power plant which is already operating based on subcritical technology, and if you have to repeat those installations, the subcritical technology based installations, the capex would be much, much lower. Of course, on the contrary, the variable cost of subcritical technologies would be marginally higher. So one has to look at the trade-off between setting up a supercritical technology and subcritical technology. So once the units are permitted, existing thermal power plants operating with subcritical are permitted to operate with expanding their fleet with subcritical, then I'm sure there is a much scope for bringing down the cost in the new bids. There is still scope for new thermal bids to be invited for balance 25-30 gigawatts. So if those bids are encouraged with subcritical by expanding the existing fleet, two advantages. One is the tariff advantage. I'm sure the tariff can considerably come down. And another thing is the subcritical being units of the size of 350, 300, 500 megawatts, they'll be more amenable to meet the grid variations, more particularly from the flexibilization point of view. This is on the thermal. Coming specifically to how they compare vis-a-vis the renewable space, the FDRE and the battery storage. So if you look at the alternate options of getting, if not 24/7, thermal offers basically 24/7 power. Whereas if you look at BESS options, be it pumped storage or battery based, they offer for a few hours, say about 6 hours or 3 hours or for 2 hours or something like that. So some of the recent bids of PSPs have resulted in a tariff of 680, 690 as compared to thermal. Whereas on the BESS, the storage cost which are recently bid out are of the order of about 1.5 lakhs. If you have to convert that in terms of tariff, that would translate about 2 rupees 60 paisa, 2 rupees 70 paisa. That is on the storage capacity. To that, you'll have to add the input power cost of, even if you assume the solar power, which is the cheapest today at about 260, 270, and there is going to be cycle losses of about 10, 12%. So again, the delivered cost of power from this BESS would be close to 560, 570 types. So today they are on par with the thermal. With the battery prices going down, probably yes, the BESS options can throw challenges to thermal. To overcome that, thermal prices also can come down if subcritical units are permitted going forward for the balance capacities, which can considerably bring down the cost at least by 50 paisa to 75 paisa.
So basically, what you're saying is that for subcritical projects, whatever penalty is there by way of lower heat rate, that is more than made up by the savings of the project cost per megawatt. Is that
exactly? Exactly, because historically, all our power plants are used to creating provision for future expansion. Wherever the existing thermal power plants are operating, if they are meant for 2 units, they always create a space for expansion for the 3rd unit and 4th unit by creating some amount of infrastructure already. So the incremental cost of setting up, expanding those units is not going to be same as a greenfield. It is sort of a brownfield expansion. So that is where the cost advantage would come.
Okay. So basically, what you are saying is, given the fact that battery prices, all inclusive, delivered cost of renewable energy is not as low as it sounds in headline prices, and the fact that battery prices can also go up because these are commodities. So it's not an open and shut case that thermal has become more competitive. They will both have a competitive placement, if I understand you correct.
Very true. Very true.
Fair enough. So that's a good perspective to get. My question to Mr. Rao was, at one point in time, there used to be a lot of, concern about the coal availability, because particularly, domestic coal had not been ramping up, and we are substantially dependent upon imported coal, and imported coal was also very expensive. But lately, we have seen progress on both domestic coal availability as well as softening of international coal prices. So going forward, how do you see, the coal piece taking over? Do you see that the current position of relatively easy availability in domestic coal and soft international prices will continue, or do you see, reversal can take place like it does for any other commodities? How do you see this whole long-term coal scenario?
Looking into the present scenario, the coal is definitely the surplus. So from the 3 years, 4 years back, we were struggling to maintain even the 15 days stock levels. Even hand to mouth, 2 days, 3 days, we were talking. And today, we are in the position to pick high grade coals and even allow to lapse the low grade coals kind of thing. And sufficiently, even the 1 month stocks are there, and still, the SECL or CAL is pushing to take the coal further. So the coal availability definitely it has gone up, and if you see whatever the projections, the demand is given, against that the Coal India is also planning more than that production levels. And moreover, if you see the plan is specifically the SECL, I'm talking with respect to the SECL. Even they are planning to reopen the underground mines. So targeting 30% of the production by 2030 should come from the underground mining. So the coal availability going forward is not going to be the issue at all. The pace what the thermal is expanding, and the coal production, the way it is expanding. And looking into this demand and supply, I expect it is going to be the stable in terms of the price front also.
So basically, we can look forward to a fairly long period of easy domestic stock situation for the coal from the coal perspective.
Yeah. Added to that, one more thing is the Gati scheme, whatever it has come up, is allowing to build a lot of railway infrastructure side also.
Mhm.
And earlier, even the coal availability, when they ramped up the production, we were facing the problem of the rakes related.
Okay.
So today, if you see, there are many locations, sidings are developed by the coal, producers. And at the same time, automatic loadings with the silos, and the less than 100 size productions has gone ahead, and which the hindrances what it was there before for loading, those things has gone out, and at the same time, availability from the railway end also is improved. Railway network is improved, and many projects are in progress. And even we could see within Chhattisgarh also, the next 2 3 years, once those things are there, those projects gets completed, I'm sure that the availability coal, even other than the pithead plants, will improve further, and then that will ease out the problem of the coal availability.
Okay. So basically positives both from the production side as well as the logistics side. So
Logistics.
that should be the takeaway for us. So, my next question is addressed to our, financing gentleman, Mr. Dash. There was a point in time when, the thermal power segment, there was a lot of, risk averseness on part of the lending community to lend, apart from maybe the CPSUs, the issues like, project implementation, whether there will be demand, whether coal will be available, whether if you take exposures to the thermal segment, will you get funding from your own financiers, some of whom may have strong green kind of thing. So how are we placed with respect to the lending community's attitude to a thermal power project? Are they seen as bankable projects, or does the lending community have some apprehensions about the long-term viability of the thermal segment?
See, if you see, during your presentation, in my dear colleague, esteemed colleagues have covered up some of this risk mitigant. As a lender, we see whether this risk are, adequately, mitigated or not. But, if you see presently, most of this, on the contractual side, there is a payment mechanism which has introduced, and payment is coming on time. So receivable risk is, almost, getting managed. The PPA are mostly standardized, which is having all the clauses. There's a fixed capacity charges, there is an index charge energy. So they have come with almost all the state discounts and settled discounts, having that, PPA more standardized way. So it is easy to, compare one discount with others, and find out what's happening. There is a fuel risk earlier, where getting the fuel was a challenge. However, this new Shakti scheme has introduced this, part one, part two, where the linkages are available. Even there is no PPA also. So that and the domestic supply of the coal has increased drastically high. So that also given the benefit of the supply side issues. There was critical technology was now started, where the PLF is very high. The emissions issues were there, which was now getting getting managed. Uh, the new guideline now, the new RBI guideline which has recently come, which take care of major risk like land, your water, approval related challenges, which has pre disbursement conditions or prerequisite to the sanction. So those, however, this is all been are challenged or addressed well. The only concern which I am now recently seeing on this supply of the BTG, where I think 3 4 years, 5 years lag time is coming up. So we need to really see how the the developer is arranging the BTG while analyzing the projects. So mostly, I think as a lender or as a banker, we can take risk on the new greenfield projects, and there is a quite good appetite is there. So as long as it's efficient, contracted, aligned to our Indian story, I think bankers are ready to take a call.
Okay. Mr. Dash, I have one question, another follow-up question related to that. I mean, this year we are seeing that, discoms have reported profit. That's what I am told, although we have not seen the detailed,
Correct.
report on the PFC website.
Hmm.
Uh, how do you see the discount? I mean, do you see this performance as a flash in the pan, or do you really see that, we can be a bit optimistic about, discom financial health for a longer period of time? I mean, how do you see the scenario?
See, if you see, distribution is the most critical, critical part of a power sector, where directly they're servicing the customer and generating the revenue for the sector itself. However, if you see this, one of the weakest link, between the power sector and which is the narrative is now slowly changing. The payment delay which was there with the IPPs has, materially reduced, than to pre 2021, which was the earlier high during pre 2021 level. Also, thanks to this introduction of the late payment service charge, which is most of a turning point. And now, if you see revamped distribution sector scheme, which is now getting focused for the reduction of AT&T losses, your smart metering is getting introduced. There's a loss-linked funding support is coming up, and the financial assistance mostly linked to the performance, not to the bucket bailout the way it was happening earlier. So lastly, this if you see recently there was a national electricity policy draft is there. It is a strong emphasis on cost-effective tariff. You have gradual reduction on the cross subsidies and direct benefit to the subsidies, and there is also timely revision encouraging through the regulatory discipline. So hence the financial health of DISCOM is no longer more of a blind spot. I know it is at the center of power sector reform. So timely payment of IPP are increasingly becoming a norms rather than exception. So we feel it will become slowly we can believe on the discount the financial will improve. You say you will come back on the how the profitability. I think other than this few private and one or two PSUs, most of them are loss making. But I think they are in the center of reform now.
Okay. Now we are heading towards the end of the webinar, and I do see a few questions in the chat box. So anyone else also who has any questions, among the guests, please, type in your questions in the chat box. We'll take it up depending upon the time. So before we go to the audience, I have one quick question to all the three gentlemen from the thermal side, from the development side. What Just one wish list from each and every one of you. What is your ask for the budget, and what do you ask from the government to expedite the creation of thermal capacities and to make the sector viable? I'd like to begin with Mr. Nagarajan, if you can have your perspective.
Two things I would have in my wish list. One is as thermal is becoming more and more balancing power, fiscal incentive for flexible operation for the thermal power sector can be considered in the budget wish list. And another thing is in the entire power sector, we have been of late seeing that the cross subsidy should be eliminated, be it the Electricity Amendment Act, which is under discussion, or whether it is the draft National Electricity Policy under discussion. Everywhere we are seeing this. Something similar has to happen on the railway freight as well. So there is certainly cross subsidy happening on the railway freight also. The commodity sector cross subsidizing the passenger sector. As a result of that, the commodity sector freights are on the higher side. So there also, if the rationalization starts, there is another area where the power prices can go down.
Okay. Same question to Mr. Bagdi. If you quickly, a couple of wish lists.
My wish list is, basically because electricity is not subject to GST. Therefore, whatever GST we pay in the input tax as an input, we are unable to get any credit of it, and it's a cost. So there has to be some mechanism whereby these GST, which is levied on the input, we have to get credit of it. That's a bit because because it's not subjected to duty, therefore all that is a part of the cost. Yeah.
Mr. Rao, one hear from you before I take a couple of questions from the audience.
Yeah, I think continuing the previous speakers, Mr. Suresh as well as Mr. Ajay points, the flexibilization side, obviously, the certain benefit is given to a certain category of the power plants. I think that should come as a overall. Specifically, when the heat rates, when the PLF is on lower side because of the backdown, and those things we need to get a compensation in terms of heat rate, in terms of higher auxiliary, in terms of even the life of the equipment related also. In addition to that, certain coal side incentives also is required as earlier, for developing the renewable sector. So like green cess was levied on the coal. So similarly, certain incentive side, either it should go down, like GST side, already Mr. Ajay told this. And this taxation side, if it goes little down, then that will be further viable uh, for the thermal sectors.
Okay. Now I take a couple of questions from the audience. Both Mr. Utsav Adani as well as Mr. Manikandan, they have expressed an apprehension that with batteries likely to become cheaper and more widespread, there could be effect on the thermal PLF. There could be the minimum PLF threshold might have to be reduced further, and there could be much wider. So anyone would like to add, as to what are the practical challenges and what could be the, complexities in running thermal at variable loads? Either of the three gentlemen from the thermal power side.
The complexity side, I'll say from the operation point of view, complexity, one of the complexity is the existing power plants where the minimum load is at 50%, and that should go down to 40% right now. So as per the norms. So that is one challenge. And at the same time, ramp down and ramp up is going to give a shock definitely to the boiler and as well as the turbine side components. And that is where though we need to see the life of the equipment and at the same time the efficiency front also.
Okay.
So, and the failures. Another thing is the reliability. The more we do the ramp up, ramp downs, the reliability also goes down in terms of the boiler tube failures. That's one of the risk which is getting carried by the thermal power plants, which are supposed to be the base load operations.
Okay. So do you think in such cases it will be good for all thermal power plants to keep some BSS capacity with them so that, during the process of ramp up and ramp down, some of the, I mean, when you're in the process of ramp down, to slow down the pace of ramp down, you store some of the power, and when you're ramping up, is that feasible or?
I think, sir, this is basically the coming up because of the renewable integration with the grid.
Right. Right.
So rather than the thermal, adding at thermal end, I think it should be done at the RE end.
Okay.
And because RE also is concentrated in few areas like Rajasthan, Gujarat, Maharashtra, these areas. And it will be more beneficial there because of one thing is the capital cost has come down there, renewable side. And the second part is, it will be, it can be supplied there itself because in the same state.
Okay. There's another question from the audience from a gentleman who hasn't identified himself. Now, his apprehension is that while the government is talking about an 80 gigawatt capacity addition under the thermal, in fact, I believe it has been revised upward. When he sees the actual dashboard of implementation, there are only 30 gigawatts which are under active implementation. So, under this circumstance, is it realistic to expect that we can add, let's say, 80 or 90 gigawatt by 2032, given that, there's a whole, time, frame for, awarding the projects and then implementing it. Mr. Das, would you like to comment on this?
Sir, it has two things. One is the financial wise and one is the technology side.
Okay.
Financial wise, I don't think it's a challenge, where banks are ready. Technology also, I have only concern of this BTG, boil turbine and generator. I think BHL and all these people are really choked now. Next 3, 4 years, 5 years, they are, all the orders are packed. So we have, but however, we have seen the last 1 year, 15 months like that. It's picked up, and 17 gigawatt, awarded. So if we can allow some import, I don't know, depending how it is, some import through China or build up this technology quickly, I think it is possible. Financially wise, I think from the lender side, there is no concern. However, because of this project finance rules and other things which protect us, only the technology side, you have to see how quickly we can get those BTG product on time.
But one point from my side, sir, related to this, I think Mr. Suresh has explained clearly related to the subcritical and supercritical differences there. And I think that is the thing which we need to take for speeding up, because subcritical technology is already available. The heat rate front, auxiliary front, all the things, net heat rate, if you see, hardly the difference is going to be less than 5%, whereas the cocktail costs are going to be much higher for the supercritical. So, looking into the scenario, probably where the power plant is required to establish at the load end, far away from the coal mines. So, maybe we can think of kind of supercritical there. But at the same time, if the plants which are coming up close to the mines, where the coal cost, because add-on logistics cost is going to be very low there. So there we can adopt a subcritical technology of a 600 megawatt range, and that will, I think, speed up the implementation.
Yes, I think that makes logical sense. Unfortunately, there are a lot of questions, and I had a lot of questions of my own, but unfortunately, we are now running out of time. And I really like to, express my sincere gratitude to all our esteemed, panel members for having taken their valuable time out to join us. I would like to thank my, colleagues Shailendra, Pranav, and others for having put together a very informative, presentation which shows light on the sector, and also to the audience for being such a patient listener and having so many questions. I wish we could have addressed all of them. But on paucity of time, I'm handing over back the stage to Mamta for your closing remarks.
Thank you, Sabyasachi, for steering such an insightful discussion. A heartfelt thanks to all our distinguished speakers. It was truly an honor to have you with us. And to our participants, thank you for joining and engaging with us today. We look forward to your feedback. For any further queries, suggestions, or comments, please feel free to respond to the feedback mail you'll receive shortly. That brings us to the end of today's CareEdge webinar. Goodbye for now. Requesting the tech team to kindly log off.
Thank
Thank
you.
you. Thank you,
Thank you,
everyone.
everyone.
Thank you. Thank you.
Thank you.